Hey everyone, my name's Andy. I'm from the Finding Value Finance channel. I've got Justin Huhn from Uranium Insider. He's so gracious to spend some time with us and give us his opinion. Thanks, Justin, for coming on. I've prepared a couple of questions for him to get your opinion on it. So thank you for coming on to the channel. I really appreciate it.
It's my pleasure. Yeah, I've been enjoying watching your content, so I'm glad you reached out. Happy to be here.
Yeah, and if you guys want to follow Justin, you can go on YouTube. He's got, I think it's Uranium Insider is his YouTube handle. I think that's correct. And you can check him out there and subscribe to him if you want to subscribe to his channel. So the first question that I've got, I usually follow commodity markets by looking at inventory levels. With uranium, it's a little difficult to do that. I don't know really how much inventory there is. It's difficult to say, where we're at in this bull market. So how much inventory is really out there in your opinion? And can we tell accurately the inventory levels?
Sure. Are you talking about just like generic mobile inventory, or are you talking about utility inventory?
Well, I would say available inventory for utilities to purchase.
Okay. So just kind of a generic inventory.
Yep.
Well, first of all, I'll say that nobody knows precisely the exact number. It's very, very difficult to pin down the exact amount of production and the exact amount that's been purchased and then resold back into the market that utilities have accumulated. But if we look at a very rough estimation of, let's say, from the previous decade's oversupply that didn't go to China, let's put that at roughly 150 million pounds of uranium. And that was an excess amount of mobile inventory that was held by various entities that took years and years to work through. So if we take that number and then we look at the deficits that we've been running for the past 4 years, since McArthur River was shut down, was kind of the primary catalyst to kind of kick into a deficit mode when they shut down McArthur River. You figure Cameco alone, between the amount of uranium that they did not produce and the amount of uranium that they purchased, we're looking at over 100 million pounds. Plus, you figure a lot of these pounds were sold back to utilities from, through carry trades. These are 2, 3, 4, 5-year contracts that were sold by carry traders to utilities. And that was a boon for utilities and a boon for traders, especially in the middle part of the last decade. Going towards the end of the part of the last decade. And then carry trade it's not irrelevant at this point, but the volumes are far lower than they used to be, primarily due to market dynamics and just the lack of above ground mobile inventory. So if you do all of those rough calculations, we had figured that we would have worked through the bulk of that by the end of last year. And so, you probably give yourself 20 million pounds of leeway in either direction, right? Because it's just impossible to know the exact number. But I feel like the market dynamics and what we're actually seeing in the spot market in particular tends to justify that assumption that we've worked through most of that mobile inventory, because we're seeing a very small volume of purchasing move the price pretty substantially. We're seeing, even just since the start of the year, up until a few weeks ago when the Sprott Physics Uranium Trust started trading at a pretty consistent discount to NAV. But when they were in the market purchasing, the beginning of the year, they were, they'd get to that premium to NAV, they'd raise the cash, they'd go out into the market and look for pounds. Right around that time, that started to shift, where they were getting phone calls all day long, where sellers were like, hey, we know you're the buyer in the market, we've got some pounds to sell. And what they've noticed, even as they were sitting on cash and active buyers in the market, let's say 3-4 weeks ago still, the phone calls just stopped. They substantially slowed down. Even sellers that they have been buying from since last summer when their ATM went live, those sellers have even started to slow down a bit. So the spot market, as far as just inventory sitting around, is relatively thin. Now, of course, the Chinese are sitting on who knows how many pounds. They have a strategic reserve, let's call it, of probably to the tune of 300 million pounds, possibly even more. Most people believe that is likely to stay in China. But there's, CGN is a pretty prominent player in the space, and they sell pounds here and there. And I know that they're sitting on a decent amount of inventory, but for the most part, the market is relatively thin in terms of standing inventory from the previous oversupply. That obviously doesn't take into account current production that comes into the market, because there's always some production, 1.5, 2 million pounds, maybe a little bit more on a monthly basis, coming from BHP, coming from the Uzbeks. The Uzbeks sell to Itachu, the Japanese traders, they sell back into the market. And then a more recent phenomenon would be like the reverse carry trade, where you have some of those pounds from that previous oversupply that the carry traders had contracted out to utilities, selling back to spot because of a backwardated market. So it's quite a complex scenario, but as far as just mobile inventory sitting in a can from previous oversupply that's just waiting to be sold in the market, we believe that there's not a whole lot of that out there at this point.
Okay, so we've got thin inventory. We'll call it thin, or not much out there. Prices are starting to move. We can see that. So that's a good indication of kind of where we are in this bull market. The inventories are always leaning out. When they lean out, that's usually when prices start to move. So we're at the beginning of the bull market. What do you think this progression of this bull market's going to look like? What can we expect as a series of events as we go through it, or at least the way that you see it?
That's a good question, because honestly, that it's sort of a moving target. Things have changed so much in this market, especially over the past year, that if you had asked me this even 3 months ago, I probably would have had at least a slightly different answer. At this point, I mean, we're witnessing, to quote Tim Gitzel from today's call, today's Cameco conference call, we're witnessing an unprecedented geopolitical shift, like a realignment geopolitically. And I don't think anybody knows exactly where this is going to settle out. I speak relatively frequently with some pretty prominent folks in the industry, and there's definitely a number of people that believe that we'll end up with a bifurcated market. We'll end up with a market where the Russians are producing, a smaller amount of uranium, less than 10% of global supply, and most of that is coming from Kazatomprom JVs. But they're huge in the conversion and enrichment market, but of course they need the feedstock for that market anyways. And most of that comes from Kazakhstan, whether or not it's their JVs. And so we could see a bifurcated market where we have the East and the West. Basically, we've got production in the East that's being sold into the East, where Kazatomprom, Kazakhstan falls into that bifurcation. I don't know, and I'm not even comfortable trying to call that at this point. But the interesting thing is that the bulk of the demand comes from the West. Even as fast as China is building, the bulk of the nuclear reactor demand is coming from the West. And currently there's insufficient pounds being produced. There's insufficient conversion and enrichment in the West to really provide that demand. So whether or not that's a bifurcation officially, it sort of is already now. It's kind of happening right in front of our eyes. And while there isn't two official separate markets, we are seeing Western utilities seek out purchases from non-Russian sources. That's happening now voluntarily on their part. Again, to quote the guys from Cameco this morning, they basically think it's a when, not an if situation that Russian supply is cut off from the West. So with all of that said, I think that looking at what's happening in the enrichment and conversion markets, I do expect the next move to be higher conversion prices still, even though we're at essentially all-time highs, higher UF6 prices, and that will trickle down to U3O8. And I think we could see some relatively dramatic moves. And that is from, quote unquote, natural demand from actual nuclear energy. That's not even looking at the financial players. And I think that the financial player aspect of the market is complicated given the where the markets are at now. I think in a everything is fine and dandy sort of world, and economies are good, and the markets are looking healthy and all of that, I think the financial players would have already cornered this and gone absolutely bonkers. And they might still do that. I'm of the belief that we will still see a very strong commodities market in the coming years. So I do think that on top of that utility demand that is coming, that we will see the financialization of the sector as well. And I don't think the utilities, and I don't think most investors have any idea how aggressive financial players can be in a market when they feel like they have it, when they've got it under their thumb, let's say. So The steps that I think that we're going to see, let's just say kind of the broad market sort of do what it's going to do, potentially go down a bit further. Maybe we'll see some sideways chop. I'm honestly not expecting a full-blown crazy recession crash, but I hope that I'm not wrong in that. And I think that when we settle out of what's going on in broad markets currently, that we'll see sort of a next leg. And I think that the clues will be there in terms of volumes, especially into the spot vehicle and the ETFs. So I think we could see potentially another leg up that's driven primarily by financials. We could see probably another pullback from there. And at that point, by the time the next leg is up for the market, I think that we could see the actual demand coming from the nuclear utilities hit the U308 market. And if that is in conjunction with the financials, then we could see a real strong move in the spot price of uranium. So timing is difficult. I really try to shy away from short-term predictions, but I honestly think we're headed for a very, very strong market. I think we're going to vastly overshoot the marginal cost of production, which, given supply chains and inflation and all that, is probably between 80 and 90 dollars a pound, maybe even more. And so we're probably going into the hundreds in the spot price of uranium, and there's really no limit to where it can go. That basically will be up to the financial players. So I think we've got a minimum of 12 to 18 months in this thing, and I think it very well could go for multiple years. I mean, we could see a 3 to 5 year, super cycle.
Yeah. Do you think, obviously I'm watching natural gas, I'm watching other energy sectors. I'm starting to see those guys really start to pull up. Do you think there's any impact from those sectors on the uranium sector as well? If we see natural gas just go ballistic in America, do you think that'll pull the uranium price up with it?
I mean, it makes sense that it would. And I think that there's definitely some correlation there, but obviously the markets do not move in lockstep. So the uranium market tends to not react to movements in the natural gas futures price, for example. But at the same time, it does have an effect in that there's deregulated markets in the States where you have, nuclear reactors that are competing in the energy markets with natural gas energy. So when natural gas is more expensive and oil is more expensive and coal is more expensive, it makes a justification for a higher uranium price much easier.
Yeah, I agree. So going back to this, do you think when we look at this, we've got the demand supply, and then we have the financial liquidity coming into the system, which is inflation. Do you think there's going to be one big spike, two spikes? Like what do you think this is going to look like? Do you think we're going to get like a financial squeeze, and then it just slowly comes back down to a level where maybe miners can come on and produce? Or do you think we'll see two spikes? Like what's kind of your expectations there?
That question is difficult to answer because I tend to want to answer it in what I'm hoping happens, to be completely honest. I think that if the Sprott Physical Uranium Trust had been granted a New York Stock Exchange listing, then I would have been strongly in the camp of, we're going to see a crazy price spike and it's going to correct back down to the marginal cost of production. And then maybe we'll resume a bull market from there. Now, I don't know. Now we could see a longer drawn out bull market. And honestly, I'm perfectly okay with that. It's healthier for the market. And in the long run, you actually can make more money as an investor than on price spike. Now, I know that's counterintuitive, but sometimes we've seen, take, for example, some of the markets that we've seen recently where we've seen commodities prices far, far outpace the movement of the equities. So we very well could have seen, like for the nickel market is a good example, that price just went to the moon and the equities couldn't catch up to the point where it essentially like broke the market. So if we had seen, let's say, NYSE style volumes, especially if there was an options market involved, which, the greedy side of me was salivating over an options market for SPUT. But it looks like it's not going to be, so that's okay. But if we would have seen the spot price just go from $55 a pound to $150 a pound in 2 months, that probably would have been disappointing from an equities perspective, even if we could have doubled or tripled our money in 2 or 3 months. You know what I mean?
Yeah.
And as an investor, you should never be disappointed in doubling your money, but a more drawn out bull market can bring greater returns on the long term for investors, and it's healthier for the market. It actually enables these companies to do something that a company wants to do, which is produce something tangible, actually make cash flow. So, and I think that that's more likely to happen now with the NYSE listing, at least for the time being, out of the picture for SPUT. And I think that also the broad markets doing what they're doing is slowing things down a bit as well. And I actually think that's a healthier thing in the long run. Let's shake some weak hands out here. Let's rip the Band-Aid off. Let's get this over with. And if we can have a relatively stable broad market underpinning a commodities bull, then we could be in for a good 2, 3, 4+ year kind of, commodities run. And I can't remember who shared it the other day on Twitter, but somebody shared a history of commodities bull markets over the last 100 years. And the average length was, I think it was either 10 years or 17 years. It was more than a decade was the average length of a commodities bull market of the 4 or 5 that we had in the past 100 years. And we're 2 years in now. So I think we have a good run ahead of us. And I think that goes for uranium as well.
That's good. That's good. I hope so too. I want it to just kind of slowly make its way up and get the largest possible value for the shareholders that, where possible. So for a new investor entering this sector, what would one need to prepare for and to expect? I mean, what should their expectations be? Because I get a lot of people that come on to the channel. I think they're all in the camp of this squeeze. Like, we want to squeeze and squeeze and squeeze and squeeze. But the realities are this may be a little bit longer and drawn out. We may have to ride through it. There's going to be lots of volatility. But what would you have for a new investor? What would you say to a new investor and say, hey, look, this is what you should prepare for. This is what the expectation should be coming into this sector of uranium?
That's a great question, especially on a day like today. I mean, today was the worst day for the markets since March 2020, in the last 2 years. And uranium is an unbelievably volatile market. So in our newsletter that we put out every month, we actually add this section every single month. So this is basically kind of our playbook for surviving volatility in this market. All right. So the first thing we always say is to make a rational portfolio allocation to this sector because of its volatility. And that obviously is subjective, right? So that means something different to everyone. Most of the time when people are panicked about paper losses or panicked about intraday movements in the stock price, they probably are overpositioned. The positions are probably too large. And I've found that in myself in the past, and it's taken a very long time for me to stomach days like today it didn't really shake me. And it was a 10% down day for my uranium portfolio, for the portfolio wide. That's a big down day for a portfolio. And it didn't really bother me, strangely enough. And a lot of that has to do with an understanding of the fundamentals, right? Which is crucial. So just to remember that this sector hits above its weight when it does move. So when it does move to the upside, it will move sometimes violently. So you don't need to put all of your eggs in this basket. We always recommend to not invest your total allocation at one time. So if you're just entering the market, to enter into tranches. So whether that's 3 or 4 or 5, that's obviously more difficult if you arrive to the thesis with X amount of dollars in your account and not necessarily more to add over time. Then you have to parse that out as you see fit. But we never recommend just coming in and throwing down 100% full size positions, on day one when you realize, oh, uranium is the next big thing, because the market will give you opportunities against all odds. Something that this market does is it hits you with positive fundamental news on an almost daily basis. And then the market corrects 20-30% out of the blue. And it really just shakes out so many people. Oh gosh. I mean, I got some emails. I got one email in particular. This was last July. And this person emailed me and was just like, this has been the most difficult 2 months of my life. And this was 1 month before SPUT came along, right? And everybody knew it was coming, but it didn't make sense to this person that nuclear is growing and the spot price is stable, and SPUT's ATM goes live 4 weeks from now, and my stocks keep selling off, and I can't take it anymore. And we sent out an email that was called Uranium Sector Gut Check, that was just a couple of days off the very bottom in July of last year, and he sold out, and he lost a chunk of money, and I'll never forget this person because you could tell that it was a painful experience for him. And just 4 weeks later, he not only would have been break even, he would have been up to the tune of hundreds of thousands of dollars just a couple of months later. So it's difficult to hang in there, but it's something that can be done, especially if you understand the fundamentals. So that's another crucial part of this, is making sure that you really feel confident in the thesis, and you can't let daily movements dictate whether or not that thesis is correct. So if the thesis can be correct over a long-term period of time, and if you actually look at charts, especially on a day like today, and you zoom out, you look at weekly charts, it's like, oh, these charts are absolutely not broken here. I still feel confident in all these fundamental factors that led me to buy into this in the beginning. So what is shaking out? Is it just fear? Is it fear that it's going to go lower? You really have to understand the fundamental thesis in order to remain invested during these shakeouts. Let's see. Don't use leverage because the sector does hit above its weight. That's especially important for beginning investors or people that are new to uranium. Just don't do it. The emotions can really, on the upside and the downside, but when things are really moving and the sector is flying and everybody's euphoric, it can be tempting to just buy front month out of the money calls and just get your face ripped off, like 2 weeks later when the sector corrects. And that happens all the time. So just don't do it. You don't need to borrow money and trade on leverage, and you don't need to trade, straight calls, especially with short expirations. That's just a recipe for disaster. I think, let me see, is there one more point here? We recommend to not become over-invested in one name. So diversification within the sector is also recommended. Just hold a basket of stocks. And if you don't want to do your own research or subscribe to a service like yours or a service like mine, where we give advice on what to buy, or recommendations, I should say, you can just go for an ETF, or you can own the physical through the SPUT vehicle. But being oversized in one name is usually, I know people that are overly invested in one name and they become obsessed with the one company, just absolutely obsessed with every little tick that the company makes on a daily basis, and it's not healthy. And it's not a very smart thing to do from a risk standpoint. So you obviously want to diversify, generally speaking, but even within the sector, you want to spread out a little bit. I think that probably wraps up some general thoughts on new investors to the space. Yeah.
You said that to understand the fundamentals, and that really allows people to, I'll say, hold through it. Is there anything right now that could shake you off the uranium track? Is there anything out there where you're like, wow, this isn't good?
That's a great question. I think the biggest thing for me would be a drastic change to demand projections. Would change how I feel about remaining invested for the mid and long term. So if let's say, for example, that China just out and said, oh, just kidding, we're canceling our build out plans. Obviously from a sentiment factor, that would affect the stocks, but also just from a sheer supply and demand factor, we would effectively be expecting more of a balanced market going out into the future. And the buying pressure that we would expect in the coming years would be reduced. So that would at least make me question things and look deeper at it. I don't know if that would make me run for the exits necessarily, because I think that a big part of this market is the short to midterm financialization of the sector. So, I think that it's important to have a grasp of the overall supply and demand fundamentals to understand that it's a growth sector, understand that we are at a supply deficit and why we're at a supply deficit and what will change that, and how does it look, 5 to 10 years from now, et cetera, et cetera. But also to recognize there's kind of this other aspect of this investment, which is, oh, there's this vehicle now where when money is poured into it, they buy physical moves and all the equities move. And so that example of, let's say, hypothetically, China canceling their build out plans, that doesn't mean that money won't still flow into spot and the spot market still isn't tight. It doesn't mean that the investment is over. It's just something that would make me definitely reconsider the long-term thesis for the investment. That's just one example, but I suppose there could be other things, like, I mean, God forbid, a nuclear accident, obviously in the short term would affect sentiment. And if it resulted in what Fukushima did, which, most of the damage from that was done because of the reactors being closed down. So that, again, a demand shock. So a negative demand shock is probably the biggest thing that would cause me to question things.
And then on the opposite side, if everything that, if everything was going well for uranium, is there anything that could come online and say, oh my goodness, I didn't even think that this demand would come from here? Do you see anything else that could maybe, we're in an energy crisis, and that's kind of what I've been looking at. We got this energy crisis with oil, natural gas, coal, and it's like, man, they're running out of these three. Is there something that politicians or the market or something where everyone just kind of turns to uranium and says it's go time?
For sure.
Could something like that happen?
Yeah, absolutely. I mean, that's one of the big reasons for me personally to be invested in this space, and one of the reasons why I'm excited about it and bullish about it is because the market is fragile enough that a disruption on the supply side can absolutely shake things up. We're seeing that now with the war. We saw that with COVID shutting mines offline, which really kind of kickstarted the bull market in a lot of commodities. But I'm going to try to paraphrase. There's your listeners and your YouTube subscribers should check out another channel. You might know him, Antonio. He has a channel called Resource Talks. He recently did an interview with Brandon Monroe, the CEO of Bannerman, and he's unbelievably knowledgeable in the space. And he talks about how he believes that because of, like you mentioned, the energy crisis situation that we're seeing skyrocketing prices. We're seeing major crises across Europe due to being cut off, or in some cases, reducing supply of Russian natural gas and oil. We're seeing energy prices skyrocket in Japan with potential, they're already warning about blackouts. Because of this situation, what we're seeing is sort of an energy crisis meets security of supply and energy security. So not only is it a clean energy and a cost-based incentive to increase nuclear, but we're also seeing security of electricity and security of energy. Those two things are kind of meeting right now. And we very well could see state-owned entities. So that could be Russian companies, or more likely Chinese companies that are all essentially state-owned, securing pounds for their own energy security. And that could come at any time, and that would absolutely shake up the market. Most people assume that because China is sitting on X amount of inventory, that they're not about to go out and secure more assets. And if you consider their build out plans, I think that's an unbelievably naive assumption. I mean, if they just announced they plan on another 10 reactors to be coming online within the next 12 months, or 12 to 18 months. And that's in line with their plans to build, let's see, they're just over 50 gigawatts now. They're planning on going to 200 gigawatts by 2035. So 150 gigawatts is about 130 reactors, roughly 125, 130 in 13 years. Okay, so that's 10 a year. That's 10 a year for the next 13 years. And 200 gigawatts, I don't have the math off the top of my head. I should. It's a lot of uranium. It's far more uranium than they're sitting on in order for them to feel secure out multiple decades for energy security. And to give one example of that, in the previous bull market, there was a 2 or 3 week period of time where the Chinese came into the market and signed 200 million pounds in long-term contracts in just a few weeks. just to make sure that they had it. So at some point, energy security and security of supply is absolutely paramount, even far above cost. So we wouldn't be surprised to see another round of term contracting like that, where you actually see nations get involved in securing supply and or assets being procured by state-owned entities. And I think that that is likely to happen in the next few years, if not sooner.
That's good to hear. I like that. I like that. So we're riding through this, at least I'm riding through this. I'm not trading in and out. I'm riding through this, waiting for the thesis to play out. And what does the end look like? What does our exit look like for uranium? What should we be looking for? What are some signs that the exit is close, or at least what are you looking at?
I think that a pretty clear sign of a blow off top will be if the spot price vastly overshoots the term price. So we're already having, I mean, currently right now, if you look at the quoted long-term price coming from, let's say, UXC, that's below the spot price. The spot price is 54 or 75 a pound. The term price is still quoted at 48, but the 3-year forward and 5-year forward are 55, 56, $57 a pound. That's essentially the term price. But if we actually see the spot price, let's say go $20, $30, $40, $50, breaching the term price, even the 3-year forward, 5-year forward prices, then that probably should look like a blow off top, and is something that we should be very careful about hanging on through that. In that scenario, if that happens, then you'll obviously want to scale out on the way up if you can. You know, it's much easier said than done, obviously, because as I mentioned, you know, emotions can get the best of everyone. It's been when things are going well, you kind of tend to think that they will continue to go well. Same thing when things are selling off. It's like, is this ever going to end? But that is one sign that we'll definitely be looking for. I think that if that happens in conjunction with flows diminishing into the spot vehicle, we'll definitely see entities that do hold physical that are not spot. Now, there were a number of hedge funds that did hold physical uranium that ended up selling that uranium to spot in exchange for trust units, just for liquidity's sake and not to actually have to hold uranium on their books. But there are still entities that hold uranium. Some of those are producing companies. I believe Uranium Energy holds 5 million pounds at this point. Denison holds a few million pounds. So if you see these non-producing companies actually selling uranium into the spot market, that's something to look for. And then, of course, you know, a number of other factors, technical charts breaking down during that same type of period of time. So if we see spot do a blow off top and start to correct, and then the charts are starting to correct, if we see actual technical breakdown of the charts, that would be a reason probably to at least take chips off the table or possibly get out for the time being. And then there's just a number of other factors. If there's a fundamental factor that comes into play that alters the thesis while things are very bullish and you're already sitting on big gains, then you probably want to lock those gains in. So that could be, like I said, like a change in demand or a change in supply that comes in unexpectedly to the fundamental situation while the market is overshooting. Then that's something to look out for.
So you said short-term pricing exceeding long-term contract pricing. Do you know what that was last bull market by any chance? Kind of when it was reaching the peak that,
oh gosh,
I don't know if you know that off the top of your head.
Off the top of my head, well, spot went to $134 a pound. I think the term price peaked at 100.
Okay.
But once spot like jumped steeply above term, it stayed that way until it peaked and reversed. It never went back down below and then back up. And I think that once it breached the term price, it was probably an 18 to 24 month run, if I recall correctly, where it was higher than the term price. But there was a moment where it really separated from the term price. So it breached it, you know, like a golden cross, and then they kind of went up together, and then the spot did this. Okay. And that was the top. Yeah.
Good. That's good to know. I like that. Is there anything outside of uranium that you have your eye on right now? Is there anything else that you're looking at?
Yeah, I'm pretty intrigued by the shipping space. I own a little bit of that. I'm quite bullish on oil. I don't know enough about the market to say I'm bullish on it for a very long term, but right now it looks pretty bullish. There was a recent, I think it was a conference call from Shell, where I believe it was the CEO of Shell who's basically saying they're seeing zero drop in demand, and yet supply is being impacted all over the place. So I find that really interesting. So I do own some oil stocks and some call spreads on some oil stocks. I'm intrigued by precious metals, though it's been an unbelievable pain trade. I think, everyone is basically just ready to throw in the towel on silver, and that's looks like something that could just tear at any point when all of the elements are basically line up with an exception of the movement of the dollar. I think maybe when the dollar finally peaks and turns, maybe the metals will finally have their run, because it's been, that's been definitely pain trade, but I'm definitely interested in that. I'm bullish on most other spaces that have to do with commodities and metals, generally speaking. I think fertilizers are intriguing here. It's looking like a pretty big mess in terms of a food crisis going forward. Unfortunately, I think that's looking pretty likely. So there's probably a lot of commodities around that space that I don't own, but are probably going to do well. But I spend most of the time on uranium, and that's what I know best. So that's where the bulk of my funds are invested in. But the other ones that I like a lot right now are shipping and oil. Natural gas has been fantastic, but I missed it. Fertilizers, I own a little bit, but I missed a lot of that run. And I hate chasing. So I'm contrarian at heart, which makes me really like silver and gold stocks. So I have a couple of long dated vertical call spreads on both silver and gold, and I'm just kind of sitting on those and hoping that the sector moves before 2024. How about yourself?
I like energy service stocks right now and shipping. Those are the two that I really like. Energy service, it just seems like, you've got all the money kind of rotating into the exploration and production companies. And these guys are just hanging back. They're like, hey, what about me? You forgot me. The money hasn't turned and flowed into it yet. And that's the one that I'm really looking at, is the energy service companies, and also shipping. I think there could be a problem in shipping at some point as things get redirected around the world away from Russia. So I think the efficiency drops, and they haven't been building ships, at least certain ships.
Yeah.
So I think, you're on it. The whole commodity complex, I think, is absolutely wonderful. Absolutely wonderful.
Agreed. It's super exciting. Yeah.
Yeah. And the money, the inflation is just it's gonna rotate money over here like you've never seen before, in my opinion. So is there anything else that you'd like to share, or anything else that you'd like to talk about with the viewers that you want to share that you think is important? Or
I don't think there's anything. I think that one thing that I thought was really striking, just to geek out on uranium for a second, from the Cameco call this morning, was, I think it was Grant Isaac speaking at this point, the CFO, and he said that, and this is something that should have been obvious, and I think was sort of obvious already to begin with, but the way that he stated it made it very clear. And that's, so Russia has been about 50% of underfeeding secondary supply. And so they're a major player in enrichment. So naturally, as a 43% of global enrichment, they've had a lot of excess supply over the years. They utilize that supply to underfeed, basically. So they, without getting too deep into it, they basically just take that excess capacity, spend more energy to spin the material, the feedstock material, down to a lower tails assay to produce more with less feed. And so they underfeed the centrifuges, and they end up with excess UF6, which is the feedstock, and they sell that into the market. So they've been a major player. They've been about half of the global secondary supply. Now, if you go back in the previous decade and up until maybe just about a year, 18 months ago, secondary supply from underfeeding and tails re-enrichment was 20, 25 million pounds a year, a major source of supply coming into this market. Major. Now, if you figure that Western utilities no longer have access to that Russian underfeeding, not only just Russian supply generally speaking, but 10 to 12 million pounds of extra supply coming from Russia and underfeeding, okay? Gone. The Western utilities cannot buy that. Then you look at the Western enrichers and what they're having to do to meet this renewed demand that's coming from the Western utilities is overfeed their centrifuges. So they're having to put in more UF6 on the front end of the process and spin that material with a higher tails assay, which means the waste material has more of the fissile isotope in it. They spin it less, basically. More feedstock, higher tails assay, less energy, higher prices, and that's because the demand is there now. And so all this excess demand is coming to the Western enrichers because of what's going on with Russia. No more underfeeding is going to come from the Western enrichers. So underfeeding, as far as the Western utility is concerned, gone. That's a big deal. That's a big deal because that's material that traders have been able to buy and then use that in a carry trade agreement, carry trade contract with utilities. So that's supply that they're not going to get going forward, at least as of now, and likely going out into at least the short to the midterm future while this scenario is here and this geopolitical realignment is happening. So that's a really big deal. And you could actually tell when he was speaking about that, you could almost hear him grinning. And so I think that's really interesting. And that just adds to the tightness in the market, knowing that there's 20+ million pounds that were there 2 years ago. Now, last year, the underfeeding already started to slip. We're probably back down to around 15 million pounds, but still, that's a lot of uranium. When we're talking about a 40-50 million pound supply deficit this year alone, 10 million pounds is a lot. 15 million pounds is a lot. So that's just one element of a very complex scenario that basically means utilities right now, they're looking at two things. And sorry to ramble on about this, but it's kind of all connected. They're looking at two things. Basically, one is SPUT for real? Are the flows going to continue? So SPUT has totally shaken up the market. Year to date, they're 50% of the spot market volume. That's never happened before. Typically the spot market volume is 80% traders moving pounds back and forth. So SPUT's totally changed the game here. And the utilities are kind of like, maybe this is a flash in the pan. We're not sure if financial flows are going to keep coming into this vehicle. You're going to keep buying pounds. We've got some inventory. Let's just kind of chill and see what's going to happen. So that's one thing that's keeping them kind of watching things. The other thing is the Russia situation. So as it is right now, the utilities that do need to buy conversion and enrichment and sign contracts, they're doing so ex-Russia. They're buying from Western suppliers. But everybody else is also just kind of like, man, we've been buying from Russia for 20 years. We can go to them and we can buy our U3O8, we can buy our conversion, we can buy our enrichment, we can buy our fabricated fuel, one-stop shop. It's cheap, they always deliver on time. Bob's your uncle. That's gone. And that's something they've relied on for a very, very long time. Gone. So the utilities are kind of sitting back right now, and they can't sit back forever. So all of those elements are coalescing. The lack of the secondary supply, the fact that a highly reputable supplier is now cut off from them, and the fact that SPUT is there, especially now. We got 3 weeks trading at a discount to NAV, so they were just like, maybe SPUT's kind of over with. Maybe that's not happening. It's super exciting because I just love these quiet moments when people start to doubt things, because that's when I get stoked.
Yeah, that's when I buy.
Right. Yeah. 100%.
Yeah. So if somebody wanted to reach out to you or follow you, how would they do that?
You can find me. Our website is uraniuminsider.com. Some of your listeners probably know we also have a newsletter. It's called Uranium Insider Pro. We've been doing it for 2.5 years now. We're just hyper focused on this sector. Have a small dedicated team of very sharp people that are behind me. I'm also on Twitter pretty frequently. I have a decent sized following there, and On days like today, I try to kind of ignore the noise that can get deafening, but I try to remain somewhat accessible there. And there's a good community. There's actually some incredibly sharp, very skilled, very highly professional, successful investors that you can chat with on Twitter. It's phenomenal. It's a phenomenal asset for an investor, to be completely honest. So I'm there pretty frequently, but yeah, I can be contacted through the website. And if anybody wants to reach out to me, feel free to do so either through the website or through Twitter.
All right. So thanks for coming on, Justin. I really appreciate it. Thanks for having, spending your time with us and sharing all the knowledge that you've got. So thanks for coming on, and appreciate it.
My pleasure. Yeah, I appreciate it. Thanks for having me.